Jerome Powell's messages about inflation are absolutely critical. And it seems that the market does not want to listen, that when the Federal Reserve mentions that inflation remains elevated and stubborn, that the core inflation rates remain too high, and that the rate hike path needs to continue, and they need to do more, which means that they need to reduce the balance sheet of the Federal Reserve. It seems that investors don't want to pay attention to this. If you look at the curve or the estimates from investors of yields and of policy rates, it's incredibly interesting to see how investors seem to believe that there will be rate cuts in the second half of the year. So far, the only messages that we can really take into account are those of the Federal Reserve, and the Federal Reserve is unquestionably clear. They're saying that the problem of inflation is much more dangerous than what they thought at the beginning. That now that we have seen commodity prices slump and most of commodities trade below the levels prior to the Ukraine invasion, that the problem is even more aggressive. Think about this. If the Federal Reserve looks at the levels of core inflation and headline inflation, and looks at the same time at the traded commodities and international markets added to the cost of freights, etc., what they will likely see, like you and I, is that if we adjusted the current inflation levels to those international commodity prices, inflation would have to be almost half where it is right now. So the level of monetary inflation, the level of the problem created by the excess of money supply needs to be corrected. And you and I may argue all the time about the level of money supply growth, but there is an evidence of excess money in the economy, and there is certainly a level of rates that remains hugely below the curve if we think of what the curve is actually telling us, not what people expect. So we need to be extremely prudent. We need to be aware of what the Fed is saying. We need to remember that in 2022, the big mistake that investors made was to think that the Fed would not do what they were saying over and over and over again that they would do. Therefore, we have to be cautious about the optimism on bond yields and on the most cyclical stocks. Inflation is always a monetary phenomenon, and now we have even more evidence that the post-pandemic inflation surge was caused by a massive increase in money supply. In a recent report by the Bank of International Settlements by Dr. Claudio Borio, and his team, they have looked at the increase in inflation, and they have seen that there is a direct link between money growth and inflation. Furthermore, in countries that had very low levels of inflation and suddenly saw a big surge in inflationary pressures, the direct impact of money growth is evident. And it's shown in this graph in particular. Huge correlation. It's important to remember this, because there is no such thing as cost-push inflation. There is no such thing as demand inflation and commodity inflation. It is always more units of currency going to relatively scarce goods and services. It is basically increasing the amount of money well above the output growth of the economy. In 2020, what we saw was a massive increase in money supply that went directly to government spending, checks, subsidies, you name it, and that created this monster inflation impact that was already evident prior to the Ukraine invasion. And let's remember, the Ukraine invasion, now we have the commodity prices, energy and food commodity prices below the pre-Ukraine war levels, and inflation continues to be elevated. In fact, core inflation continues to rise. So ultimately, all prices do not rise in unison if it's not because of a force which is monetary. You can see one or two prices, the unit prices may increase, but aggregate prices can only increase at the same time because of more units of currency going to the same goods and services, and with money growth well above the output. So the solution will be monetary. The problem was a monetary problem. The Chinese government has announced its new GDP growth target for 2023, and it has been deemed like a small disappointment because it's around 5% growth. Hold on a second. A 5% growth for China is a great number. It is a very good figure that shows that the economy can come back from the COVID-0 policy very quickly, and that it does not need a massive monetary or fiscal stimulus. In fact, if China delivers that 5% growth, what it will show the world is that China can come back quickly out of a significant challenge like the real estate sector problems, plus the COVID-0 policy, and do it stronger. And why stronger? Because it will not need massive monetary stimulus, much higher levels of debt, and much higher levels of imbalances in the real estate or the construction sector. So come to think about it, when we see headlines saying that China growth is not as expected, it is actually better than expected if we outstrip the estimates of massive monetary and fiscal stimulus that consensus had. And for me, it is better to have a 5% growth with no monetary and fiscal stimulus, or at least very limited or prudent fiscal and monetary policy, than to have very poor growth with low productivity and elevated levels of unemployment, like what we're seeing in the European Union, with enormous monetary stimulus and massive government deficit spending. So if we think about it, the 5% China growth is good news for the world, and it's much better news for China in the long term. Higher core inflation, weaker credit demand. Central banks need to at least start to think about what are they going to prioritize in their decisions, because that is what's going on in the United States, that is what's going on in the Eurozone economic area. That on the one hand, core inflation is extremely stubborn and elevated and making central banks need to hike rates faster and do a strong commitment to reducing the balance sheet of the central bank. And on the other hand, credit demand slump is very concerning. It's very concerning because it shows that citizens, that families and businesses are hurting from the inflationary impact and the rate hike impact at the same time. Governments don't care. They're just spending and spending like there's no tomorrow, which may maintain the level of elevated core inflation higher for longer. And at the same time, central banks don't know what to do, because if governments don't reduce aggregate demand and at the same time inflation remains stubbornly high, the risk of stagflation continues to be extremely high. And I come back to the point about economic growth, is that what we're seeing is the incredibly poor multiplier effect of stimulus packages. The S&P 500 estimates of earnings are coming down, and they're coming down not just for 2023 but for 2024. So we have mentioned a number of times in this program the risk of what we call an earnings recession. And so far, in the fourth quarter of 2022, the published figures, results haven't been that bad. Earnings and sales, surprise, have been decent. Nothing to write home about, but decent. However, this reduction in estimates from analysts is very concerning. It's very concerning for a very simple fact, is that you may actually have an earnings surprise coming after a massive downgrade of estimates, which means that the massage of consensus, the level of bringing down estimates is too aggressive, and it makes many of the companies, many of the stocks, very at least impacted by this very important risk, at least certainly one that we should pay attention to, of earnings recession. It's very difficult to see margin expansion in the current environment, so it's better to avoid those stocks that require margin expansion and that require cyclical growth, and look at the least impacted by the economic cycle. Commodity prices have been correcting quite significantly since the rate hikes started to be implemented. If we think about it, in the middle of the Ukraine war, with geopolitical tensions and with growing demand coming from China and emerging economies, the reality is that energy commodities, food commodities, and industrial commodities are all trading below the levels prior to the Ukraine invasion. And this, on the one hand, this level of disinflation is fully because of the rate hikes. Less exuberance in terms of taking storage, taking long-term positions, refinancing margin calls, etc. A lot less of the monetary effect in commodities is making this change significantly. Now, there's a problem. In Europe, the CO2 cost, which is a hidden tax by which European governments will collect more than 20 billion euros in taxes in 2023, has continued to rise despite the slump in natural gas prices and despite the slump in coal and in oil prices. That increase comes because governments have limited the supply of CO2 emissions targets, and the supply of those CO2 emission permits is essential for the industry. So what that means is that is going to maintain electricity prices for households elevated even in an environment of commodity prices that have been correcting significantly, and that is a bad sign for competitiveness. And that hidden tax, the CO2 tax, is making all of the energy complex more expensive in relative and in absolute terms for Europeans. More importantly, is making European citizens pay twice and three times sometimes for the same green policies, because they pay it in subsidies, they pay it in the CO2 costs, and at the same time in the different aspects of the value chain that are affected by energy prices. Let's pay attention to this. In recent times, we do not talk enough about emerging economies and the importance of the US dollar in the emerging economies development. The big problem for emerging economies is to find financing in hard currency, i.e. in US dollars. The level of confidence to take debt in local currency is very, very weak. But at the same time, most of the developed economies that we follow are following a very dangerous path of twin deficits, fiscal and trade deficits. When commodities were rising, emerging economies would see an important inflow of US dollars that could help them finance their twin deficits. However, when those deficits remain and at the same time commodity prices come down, exports are not enough to cover the monetary imbalances. So depreciation of the currency is something that we need to look at very much in detail, because it's been going on for a while. Depreciation against the US dollar, because the confidence from domestic investors and from foreign investors on the local currency diminishes as governments imprudently increase spending despite the very weak level of reserves, and at the same time the commodity cycle turns and their inflows of dollars are diminishing. So we have to look at a number of economies in this kind of risk. Brazil, that intends to massively increase spending while at the same time continue to maintain the imbalances of the previous years. Second, all of the Latin American economies that have started to look at Argentina as an example of what to do, which I find amusing, in terms of monetary policy, which is to print like there's no tomorrow local currency. Think about India as well. India has an important problem with the rupee, although the budget is a lot better prepared in order to avoid large imbalances. So the risk of emerging economies' currencies and what is called the sudden stop is coming back, and we need to look at it in detail in the next programs. European bond yields are showing the inversion of the curve very aggressively. If we look at the 2-10 curve in Germany, it's at the most inverted level in 30 years. Does this mean that there's going to be a crisis or a recession? Maybe not, but it certainly means that investors are betting too much on governments continuing to lead the economy into stagflation and central banks bringing their rates down afterwards. So it's a very strange bet, to be fairly honest. But if we look at it, the reality is that a negative yield curve, an inverted yield curve, is showing up all over the European spectrum, and that it is very clearly giving us the idea that two negative things may happen. One, a recession. Two, a slump in the level of confidence about the economy that leads bonds, German bonds, to go back to negative yielding territory. So all of those factors are not positive. We would need some level of reduction in that inversion for investors to be as confident as they seem to be with bonds, with European sovereign bonds in particular. The new estimates for global economic growth show a very modest 2.1%. It's a decent growth level for the world, and it's showing, on the one hand, that the Brazil, Russia, India, China complex, if we want to call it like that, is led by the growth in China and India with around 5% growth. However, Russia and Brazil are likely to show contraction or stagnation. If we look at the rest of the world, Latin America lags behind, Asia continues to lead the global growth, and the Eurozone sort of escapes the recession, but it only escapes the recession because imports are cheaper. Nothing robust about growth in consumption or investment. The United States may escape recession, but the main factor that makes the United States escape recession is elevated government spending. So if we think about it, it's a very unappealing level of economic growth for 2023 that highlights the very poor multiplier effect of government spending and the incredibly weak multiplier effect of all of those trillion-dollar stimulus plans that were implemented a few years back. The global supply chain pressure index has slumped and is now in negative territory. What does this mean? That governments cannot blame supply chain disruptions on inflation anymore. That the reality is that the supply chain index shows that there is ample and levels of supply, that there is no relevant tightness. It is also proven by the price action of the Baltic Dry Index, the freight index. In all of that environment, what we need to understand is that governments cannot blame on commodities and on supply chain disruptions the inflationary pressures anymore. And therefore, what they need to pay attention is to the increase in government spending, which means consuming more units of currency, and the policy of their central banks.